exchange-traded notes, an alternative to ETF. If you're new to our channel, then subscribe and stay connected with us by like, comment, and share this video. Exchange-traded notes, ETN, are close cousins to exchange-traded funds, ETF, but there are some key structural differences. For investors interested in exploring this kind of investment, it's important to know how they work when it comes to index investing and compared to ETF. ETN vs. ETF. ETN are structured products that are issued as senior debt notes, while ETFs represent a stake in an underlying commodity. ETN are more like bonds in that they are unsecured. Provide investments into a fund that holds the assets it tracks, like stocks, bonds, or gold. Barclays Bank plc, a 300-year-old financial institution with hundreds of millions in assets and a good credit rating from Standard & Poor's, provides its ETNs with a fairly dependable backing. But even with this kind of credibility, the investments are not free of credit risk. Despite its reputation, Barclays will never be as safe as a central bank, as we witness with the downfall of major banks, such as Lehman Brothers and Bear Stearns, during the 2007-2009 financial crisis. Even more stringent regulations requiring more safety capital don't make banks completely immune from collapse. Distinctions in tax treatment. ETN track their underlying indexes minus an annual expense per year. Unlike ETF, there are no tracking errors with ETN. Investors should treat ETFs as prepaid contracts. This means that any difference between the sale and purchase will be classified as capital gains. In comparison, the return from commodity-based ETFs will come from the interest on Treasury bills, short-term capital gains realized on the rolling of futures contracts, and long-term capital gains. In comparison, the return from commodity-based ETFs will come from the interest on Treasury bills, short-term capital gains realized on the rolling of futures contracts, and long-term capital gains. However, the owner of an ETN will owe income taxes on interest or coupon payments made by the ETN. For international investors, the differences are compounded as a treatment for these capital gains and will be treated differently in their home countries. Which is better? Now that you have a better understanding of the differences between ETN and ETF, which one should you choose? To some degree, that will be determined by your tax bracket and your investment time horizon. While the biggest benefit of an ETN is that the entire gain is treated as a capital gain, this gain is also deferred until the security is either sold or matures. That is something that should not be taken lightly by tax-conscious, long-term investors. With an ETF, capital gains and losses are realized as each futures contract is rolled into another one. For more in-depth analysis and exclusive content, visit our website at financialmarkets.online. Don't forget to like this video, subscribe to our channel, and hit the notification bell to stay updated on the latest financial trends.